Lot calculation in Forex, a precise methodology for traders. Understanding. Lot size in Forex trading is essential for managing your risk and maximizing your profits. Many new traders make the mistake of over-leveraging or choosing random lot sizes without knowing the exact impact on their account. In this video, we'll break down how to calculate lot size precisely, step by step. 1. What is a lot in Forex? A lot is the standardized quantity of a trading instrument. In Forex, one standard lot equals 100,000 units. One mini lot equals 10,000 units. One micro lot equals 1,000 units. One nano lot equals 100 units. Depending on your account size, strategy, and risk tolerance, choosing the correct lot size can mean the difference between consistent growth and unnecessary losses. The 3 key inputs for lot calculation. To calculate your lot size precisely, you need account balance, how much money you have, risk percentage per trade, commonly 1% or 2% of your capital, stop loss in pips, distance between your entry and stop loss. The lot size formula. Here's the basic formula for lot size. Lot size equals account balance times risk percent divided by stop loss in pips times pip value. Let's say account equals $1,000, risk equals 2% $20, stop loss equals 50 pips. Pip value, 1 microlot on EUR/USD, is approximately $0.1. So, $20 divided by 50 times $0.1 equals 4 microlots. You can use FXCM's lot size calculator to automate this, but understanding the logic helps with better decision making. 4th, consistency is key. Using a consistent lot calculation method keeps your risk fixed across different trades and currency pairs, helping you avoid emotional decisions and account blowouts. Conclusion. Lot size isn't random. It's a strategic decision that should align with your risk tolerance and market analysis. With FXCM's trading platform, you have the tools to calculate and execute trades accurately. Remember, trade size controls risk, not just opportunity.